RateScope here. What do you do when the assets you bought to protect you suddenly start behaving like the riskiest tech stock? That's exactly what just happened with gold and silver. For months, they went vertical. Gold ripping past $5,000, silver punching through $115 an ounce. New all-time highs, euphoria, safe haven headlines everywhere. Social media feeds full of $10,000 gold incoming, $200 silver is inevitable, and people posting their stacks like it was a status symbol. And then, in just a few days, air pocket. Gold sliced back down below $5,000. Silver cratered from $115 to around $80. Billions in perceived wealth. Gone. Years' worth of protection for some late buyers wiped out in a single move. That move wasn't just volatility, it was a message. In this video, we're going to decode what this crash really says about the broader market, the Fed, how safe havens actually behave in 2026, and what it all means for your money right now. Let's get into it. Under the old rules, this story should have been simple. Gold and silver are what you reach for when you're worried. Worried about recession, worried about inflation eating your paycheck, worried about geopolitical chaos or a crisis of confidence in the financial system. They're supposed to be safe havens, tangible assets that hold value when paper promises look shaky. Stuff you can hold in your hand when you don't trust digits on a screen. So when prices were screaming higher over the past few months, the narrative was clear. Investors are scared, they're seeking shelter. And to be fair, that story made sense for a while. Inflation had been stubborn, government debt was exploding. Headlines about wars, elections, and de-dollarization were everywhere. That's exactly the kind of backdrop where you'd expect gold and silver to quietly grind higher as nervous money looks for a home. But the piece that kicked off this video points out something most people missed. There was also a healthy dose of speculation in that move. Commentators were comparing the swings in silver and gold to meme stock volatility. That is a giant red flag, because when your supposed safe haven starts trading like a lottery ticket, you're not just hedging risk anymore, you're chasing it. And that's what the late January crash really exposed. This wasn't just cautious capital seeking safety. It was hot money, leverage, FOMO, and narratives all piling into the same trade, and then trying to exit through the same tiny door. The late January crash was the moment the market flipped the lights on and showed you what was really going on under the surface. So what actually triggered the plunge? On January 30th, one headline hit the tape and the entire metals trade flinched. President Trump announced his pick to lead the Federal Reserve after Jerome Powell's term ends in May. Kevin Warsh. If you don't know him, Warsh is a former Fed governor and a longtime critic of the ultra-aggressive post-2008 stimulus playbook. He's been vocal about the risks of keeping money too loose for too long. Markets immediately read this as, the next Fed chair might be more orthodox, and maybe even more independent. The article summarized it this way. The pick appeared to ease investor concerns about the Fed's independence. In plain English, less fear of a politically captured Fed, less fear of intentionally runaway inflation, less fear of totally unanchored monetary policy. And here's the punchline. The mere nomination of someone perceived as more traditional and hawkish was enough to trigger a double-digit crash in gold and silver. That tells you something important. The big run-up wasn't just about the economy. It wasn't just about slow-moving inflation fundamentals. It was heavily about a story. A Fed that might let inflation run hot. A Fed that might be pressured politically to juice markets. A Fed that might keep rates artificially low for too long. Once Warsh entered the picture, a lot of that speculative narrative evaporated. The bet that the Fed will lose the plot so I'm hiding in metals suddenly looked less attractive. And all the hot money that had rushed into gold and silver on that story, it tried to rush out at the same time. That's not how a classic sleepy safe haven behaves. That's how a crowded trade behaves. This is where we get to the heart of the story. The way gold and silver traded around this news tells us they've morphed, at least for a big chunk of the market. They weren't just functioning as long-term stores of value. They became a way to speculate on confidence in the new Fed chair. Let that sink in. People weren't just buying a bar of metal. They were buying exposure to political appointments, perceived Fed independence, future policy credibility. That's a far cry from the boring sleep-well-at-night asset gold is supposed to be. And zoom out to the rest of the market. The S&P 500 is up year to date. Credit spreads aren't blowing out. Concerns about a completely unmoored Fed cooled after the Warsh news. So as the article notes, there may now be less appetite, in the near term, for these traditionally low-risk assets. Keyword, traditionally. Because behavior like this forces a hard question. Are gold and silver actually reducing your portfolio risk? Or are they just another volatility engine disguised as a hedge? Think about what a true safe haven is supposed to do. It should have low correlation to stocks in bad times. It should help smooth drawdowns. It shouldn't be hypersensitive to one political headline in a single day. If your hedge can drop 20 to 30% on a sentiment shift, is it really a hedge? Or just a different flavor of risk? The piece even warns that for investors using gold and silver strictly to diversify and reduce risk, these metals might now be adding risk and drawdowns instead. That's the big revelation. In today's market, nothing is truly low risk if enough speculative capital piles in. And that raises the next logical question. What do you actually do with this information? Let's frame it in 3 moves. 1. Rethink your diversification playbook. If you've been treating gold as a calm, non-correlated counterweight to your stocks, it's time to retest that assumption. Recent price action shows gold can be heavily sensitive to Fed headlines, whipsawed by speculative flows, correlated to fear in politics, not just fundamentals. So pull up a chart, not just of performance, but of drawdowns. How much did your metals position drop at the worst point of this move? How did that compare to your stock allocation? Did gold and silver actually soften your portfolio's swings or make them worse? Ask yourself honestly, is this position offsetting your risk or is it now amplifying it? Diversification isn't about owning many different things, it's about owning different drivers of return. If 2 assets are now being driven by the same macro narrative, what will the Fed do? Then they're less diversified than they look. 2. Clarify your why. Not all gold and silver exposure is the same. If you're stacking physical bars and coins as a 30-year insurance policy against extreme scenarios, that's one game. You're not checking the price every day, and you're mentally writing that off as catastrophe insurance. If you're trading a silver ETF on short-term Fed rumors, that's a completely different high-beta game. You're effectively running a macro trading book, whether you admit it or not. The crash is your reminder. You cannot treat those 2 strategies as if they're the same safe haven. So be brutally clear with yourself. Am I holding this for insurance, or am I secretly hoping for a moonshot? What time frame am I truly operating on? 3 months, 3 years, or 30 years? How would I feel if this position dropped another 20% from here? If your answers don't line up with the way the asset actually trades, something in your strategy needs to change. 3. Watch for the contrarian signal. The article makes an important point. If it turns out the new Fed chair is less independent than the market currently assumes, if credibility gets questioned again, you could see another rush into gold and silver. Translation: this crash might be setting up the next phase of the metals trade. But now you go into it with eyes open. You're not buying serenity. You're buying volatility tied to central bank politics. In other words, if you're going to play that game, size it appropriately. Treat it like a tactical trade, not the cornerstone of your retirement. And have clear entry and exit criteria, not just vibes. Now let's make all of this concrete with the vehicle a lot of retail money used in this move. The iShares Silver Trust, ticker SLV. This is the go-to ETF for people who want silver exposure without physically storing bars. On paper, it's simple. It holds silver in trust. Each share represents a claim on a slice of that silver. You get price exposure without needing a safe or a vault. In practice, it became the perfect tool for this kind of speculative cycle. You can buy and sell it instantly in any brokerage account. You can layer options and leverage on top. You can ride momentum without ever touching a physical coin. Look at what just happened. SLV rockets to a high of $109.83. Then it gives back 31% from that peak. And even after that, it's still about 10% up year to date. What does that tell you? The upside run was extreme. The snapback was brutal, and anyone who chased late is nursing serious pain, even though the year's net number still looks okay on paper. SLV basically became the poster child for silver speculation. Easy to trade, low friction for momentum money, perfect vehicle for short-term bets on Fed chaos and inflation narratives. The article uses SLV as Exhibit A for this question. Should you buy iShares Silver Trust right now? From a RateScope perspective, that's the wrong first question. The better questions are, do you understand what is actually driving this instrument? Fear, flows, or fundamentals? Are you prepared for 30% drawdowns in something you might be mentally labeling a hedge? And are you okay with your safe haven acting like a leveraged macro trade? Because if what you really want is income, compounding, exposure to actual value creation, then there's a whole other menu you should be looking at. The authors of that piece come from the stock picking world, and they make a sharp contrast that's worth sitting with, even if you love metals. They basically say, dividend payers, and especially diversified dividend ETFs, give you a real underlying business with products, customers, and cash flow. A stream of income you can either spend or reinvest. Some buffer in down markets because dividends soften the blow of price volatility. You don't have to agree 100%. At RateScope, we see a role for both. Hard assets as long-term insurance and optionality. High-quality businesses as your primary engine of wealth. But the crash in gold and silver is a vivid reminder. If you treat speculative instruments like safety nets, don't be surprised when they behave like trampolines instead. Let's bring this together. The gold and silver crash was triggered by a single Fed chair announcement that restored some confidence in central bank independence. That move exposed just how speculative these so-called safe havens had become, trading on politics and sentiment as much as fundamentals. For many portfolios, metals may now be adding volatility instead of smoothing it. And the real long-term wealth engine is still what it's always been, owning great businesses through thick and thin. So here's the real takeaway. A small, clearly defined allocation to metals? Fine, especially if you treat it as multi-decade insurance. But the core of your portfolio, the 80, 90, 95% that's supposed to carry you into retirement, that belongs in productive assets. Companies, dividends, cash flows, real value creation. So I want to hear from you. Has this changed how you see gold and silver, as insurance, as a trade, or as something you're stepping away from? Are you shifting more toward dividend-paying stocks and quality businesses instead of trying to time metals? And if you are still holding metals, what's your time horizon and exit plan? Drop your thoughts in the comments. This is a conversation the mainstream isn't really having. If this breakdown helped you see the move in gold and silver in a new light, hit that like button. It helps more investors find RateScope. Make sure you're subscribed with notifications on so you don't miss our next deep dive into the signals behind the headlines. And as always, smart money doesn't sit, it moves deliberately. Thanks for watching. Stay sharp and I'll see you in the next one.